Welcome to the Capital Exchange. I'm Steve Wilbur, Managing Director at Allen Capital Group.
And I'm Travis Portwood, Chief Investment Officer with Allen Capital Group.
Travis, we talk with our clients about our bucket strategy, and it is important to have tax-deferred money such as IRAs or 401ks, a non-qualified bucket such as brokerage accounts or any taxable accounts that you may have, and that tax-free bucket such as a Roth IRA or a Roth 401k. But due to income restrictions, overwhelmingly the smallest bucket is always that tax-free bucket. And so let's talk about how we can move money into that tax-free bucket.
Yeah, for high income individuals or people, one of the more popular methods has come to be known as the backdoor Roth conversion. Now, this method involves two steps. The first step is you make a non-deductible contribution to an IRA, a regular IRA account. But because it's non-deductible, this is after-tax money. Step two is you convert that non-deductible contribution to a Roth IRA. Again, this money's already been taxed, so there's no tax on the conversion. When using this method, though, Steve, it is important to be aware of the IRS aggregation rule for IRAs.
Travis, this is where it gets complicated because it's not just as easy as putting money into an IRA and then converting it to the Roth IRA, is it?
It gets a little complicated here because the IRS doesn't allow you to pick the specific dollars you want to convert. You actually have to consider all of the dollars you have across all of your IRA accounts, how much is pre-tax, how much is after-tax, and apply that percentage to the conversion.
So let's use an example. I have a well-established IRA with $99,000 in it. I want to do this Roth conversion, and I make too much just to put it straight into the Roth. So I take $1,000 of non-deductible money and I put into my IRA. And then I want to move that over to the Roth. How are they going to handle that?
Well, you can do that, Steve, but thanks to that aggregation rule we just talked about, 99% of your conversion will be exposed to tax because 99%, or the $99,000 you started with, was pre-tax money. Only 1%, or the $1,000 non-deductible contribution you made, was after tax. So you apply that percentage to your $1,000 conversion, and 99% is exposed to tax.
Let's use a different example now where I don't have that well-established IRA. And so I make too much money still to put it into the Roth directly. So I take my $1,000 non-deductible contribution and put it into my IRA. How are they going to handle that?
So now, again, we look across all your IRAs, and you only have $1,000 in your IRAs, and that $1,000 is a non-deductible contribution, so it's after tax. So 100% of your conversion will be tax-free because you've already paid taxes on that money. It's also important to point out, Steve, that each one of these conversions you do is subject to the Roth 5-year rule, meaning, assuming you're 59 and a half, you can't withdraw earnings on the dollars you put into a Roth IRA unless it's been in there at least 5 years.
You know, another way to fill up this bucket too, Travis, is to check with your employer. See if they have a Roth 401k that you can contribute to because there are no income restrictions on those types of vehicles.
Yeah, and because there's no income restrictions, it's definitely an avenue you should explore to help fill up that Roth bucket like we like to talk about.
Travis, this has been great. I look forward to it next week.
I look forward to it as well, Steve.
If you'd like to learn how to fill up your tax-free bucket, our contact information is below, and we look forward to speaking with you.